be in the middle of a session. Okay, we have three presentation, a break, and three presentation, and we come back, to summarize and to start with a few first conclusions. Our conclusions. We'll be back on the conclusions after the second session. That's what we'll do. Remember that I will leave you anyway a few days after the end of the course to improve your slides, and you will send to Tram or to Lynn the last version of your slides, and I said that about 10 days seems to be good. We offer you the possibility to improve them and to write also a short report which is required on after your presentation. And the final grade is split between the quality of your presentation, the quality of the slides, and the quality of a report. It's 3 different grades, and at the end, for the what I call the assignment, I made the arithmetic average of the 3 grades. So let's start with the first presentation, and as far as I know, the first presentation is coming from Hanoi. It's Hanoi group number 1, and it will be followed by Ho Chi Minh City number 1, Hanoi number 3, Ho Chi Minh City number 3, Hanoi number 5, and Ho Chi Minh City number 5. So if you are ready, you can start right now. Hanoi group number 1 with your presentation. Are you ready? No one. Hanoi group number 1, do you hear me? Oh.
Yes, we're ready, Professor.
Okay, so you can start whenever you want. If you think you are ready, you can start. All of us were ready to hear you and to interact also with you.
Okay, just a second, and we will share the slide.
Okay, I don't see the slide.
Quỳnh Anh ơi, em đã share slide chưa? Okay.
Okay, something happened. Yeah, that's it.
Okay.
I see your slide. So if everyone now has got the slides on the screen, you can start with your presentation.
Hello.
Hello.
Oh, I'm sorry. Yeah. Good evening, Professor and teammate. So on behalf of team, I will present a case for biotechnology. So when I plus next slide, please.
Okay. Just wait a second.
Perhaps you can you speak closer to your microphone, perhaps?
Okay, can you hear clearly now? Or?
Yeah.
Sorry, wait, there's some technical issue. Okay.
Yeah.
So in the presentation, we will cover 6 area. One, we will go briefly about the background of the company, and then we will go SCQA framework in order to understanding more about the financial strategy for the company. And for answering, we will go detail for the financial policy, the choice of funds, the pro and cons for IPO, and we will close with the company evaluation and conclusions. So first of all, I will walk through with the background of biotechnology. So the company is long established. It has been established for more than 15 years. We are doing business in a very high growth economic sector, which is bioanalytical industries. We are in a market, we operate in both domestic and international market with a huge potential to grow. And our customer base are diversified to avoid the central risk. So our customer, including both large and small enterprise. The shareholder that we have, Mr. Vincent, is a main shareholder and board director with up to 70%. And the investment plan for the next 5 years, we focus more main priority investment focus for the construction of new production unit and for investment for existing manufacturing unit accounted for more than 59% for investment plan. Okay, this gives you the overview of the SWOT for biotechnology company. So the company has 2 strengths. One is advanced in technology and infrastructure in manufacturing. And we are having a very well management of financial ratios. The weakness that we are currently facing the rapid growth in liabilities, as well as pressure for large investment needs. For opportunity that we are working in accelerating growth sector with a little competition in both local and foreign market. There are potential business expansion in global market that we are aiming for. There's a few threats for biotechnology that we are facing market technology risk and competition from emerging competitors due to a high role in the industry. And the last one will be the business management issue due to the participation of the new shareholders. So for SCQA, for the financial strategy, we would like to walk you through a few key things. So the situation need, as you know, the company currently need a high capital investment for long-term development in the next 5 years in order to meet our projected cash flows and remain a competitive advantage. For the complication that we are facing a serious cash shortage problem for the next 2 years with our investment plan schedules. And also the management team also concerning of losing the control by increasing equities. And we are also considering of controlling a financial leverage ratio, the debt to equity ratios. So the question here is that how we can find the appropriate funding strategy to cover our investment needs and still meet the projected cash flow in the next 5 years. So there are 3 questions, 3 answers that we need to answer. What is the right financial policy for the company in this situation? What we need to make the decision for choice of fund, and what is the company valuation value for IPO? Okay, so for the financial policy that we already know, the dividend that we are planning to issue given 25 million euro in the next 5-year period. Due to the high investment need for the next 2 years that we are thinking there will be no dividend paid for the first 2 years. Or if the net income of the following year is less than 0. And we are currently in the high growth industry, so we don't want to payout ratio of 100% of our own net income. So we're thinking the maximum, the payout ratio should be not higher than 80% of net income. For debt policy, because we are having a cash shortage for short term, so we think that the mid and long term debt should be a first prioritization for choice of fund. And the debt to equity ratio that we don't want to have a higher, we want to keep it lower than under 1.0. And all debt option that we will need meet up to 1,000 euro. So equity issue that will be a second choice of fund is only used in order to keep the debt to equity ratio under 1.0. Next, Divana. Okay, so from those financial policy that we have come up with the calculation for choice of funds, as you can see here, that it show the two hypotheses in optimistic and the others. So the first 2 years, you can see that we are having a financial need of about 26 million in next year and 23 million with hypothesis 1. And on hypothesis 2, we need more because we have a lower net income due to lower margins for sales. And with that, wait, go back, please. Okay. So as you can see here that we are using debt first, and then we are issuing more equity in order to meet the financial need. And for the next 2 years, we with this choice of fund, we are okay to keep the debt to income ratio as under 1.0. If you look closely on 2003 and onward, we didn't calculate the new debt accumulated. However, without any repayment, it's also make the debt to equity ratio is under 100%, so still under 1.0. So we don't want to bother to calculate the repayment schedule for the new debt option because without any repayment, it's still under 1.0. Next year. So there's some pro and cons for the IPO. This pro is that we have a quick cash raising and low to in order to keep a low debt to income ratio as we expected, and we will provide funding for operation expense and improve company branding. The point is that it will costly for a company to go IPO. The company needs to follow more stringent standards, periodic audits, and public reportings. IPO may distract the company from operation and market activities. However, that we think in this situation for biotechnology, the company need to go with the IPO in order to raising equity and to keep the debt to equity ratio under 1.0. So there are a few methods that we have applied in order to calculate a company value. The first, we use the P over E multiply method. So we use the net earning in both hypothesis 1 and hypothesis 2 into year 2001. We have determined the number of outstanding share, and we have the P over E market ratio. So so from that, we will be able to calculate the firm value. With the B over B method, with the choice of fund that we get it from the book value, we multiply for the market value and we get the firm value. And the last method that we use to come up with the company valuation is the discounted cash flow, which we get is from two ways to calculate it. The first two steps. The first step that we need to get the discounted factor, we depend uses by the debt leverage of weighted of debt and weighted equity multiplied by cost of debt and cost of equities. And we get the cash flow that we have determined from the projected cash flow for both hypothesis 1 and hypothesis 2 in 2000 from 2001 to 2005. And additional what we need to calculate for the terminal value of the cash flow in 2006. So the terminal value that is in this case for both hypothesis 1 and hypothesis 2 that there are no growth in the net income after 2006, it will remain constant. So it's more like a repetitive calculation and add up those two value, terminal value and the present value of the free cash flow that we have projected from 2001 to 2005, that we were able to determine the value of for hypothesis 1 and hypothesis 2 with this method, the discounted cash flow methods. So this is an overview of the comparison of the 3 different methods under 2 different hypotheses. And we are conclude that we are recommend of using a discounted free cash flow method in order to determine the value of the firm for go to IPO. And the recommendation why we recommend to use the discounted cash flow method is that, as you can see, that if you use B over E or B method, it present only the net the current value of the company by using the net earning or the book value of the company in 2001. It's not really represent all the financial indicator of the company. And it's not present the unique company in this specific biotechnology case. However, the free cash flow method is the faster the project cash flow and the investment replaced by the reinvestment plan, as well as the revenue and all the things of the cash flow in the next 5 years. And it's also use the WACC under the financial indicator of this specific firm. So it will be more convenient for a potential investor to believe in the pricing method if we're using FCF method in this case. And here's an appendix to show the detail of the income statement, cash flow statement, how we come up with the loan schedule and the depreciation schedule. Yep, and we'll pause here so to hear more of professor feedback or other team questions.
Okay, thank you very much. So of course, with have a few questions and probably your colleagues also. So first question is about dividend. If I understand what you did, you don't distribute dividend for the first 2 years and you start again after on your
Yep.
free. That means you give a priority to the cash position of a firm versus against the motivation of the investors, because we can argue both sides. You have your position, which is there's no cash available.
Sao mọi người hay vậy? Vừa nghe thầy mà vừa nói.
Hello.
Okay.
Okay. Yeah. Wunan, can you flash the appendix for cash flow and income statement so it's easier for the professor and the team and the classmate can see it.
Sure. So you want to see the dividends or the
No.
It was one of your first slides. At the beginning, you had the slide. We saw clearly what you did, I think, or perhaps it is here also.
Yeah, this one, the full.
My question was about the dividend policy. Yeah? It's not a criticism. We have to discuss about that because there is no truth. You can argue now. You can argue both sides. I mean, here it's we don't make any kind of distribution of dividend the first 2 years, and the main explanation is that the company biotechnology is short of cash during that period. On the contrary, we can also argue that they have to make a distribution of dividend just because after that they want to issue new shares, and when you want to issue new shares, you have to bring some motivations to the potential investors, and one of the motivation, of course, is to have a recurrent dividend policy. So both explanations can be accepted, and you choose the first one. You choose the cash position, and that's clear.
Yes. So do you want to hear us why we choose this decision? Yes. So our first prioritization.
No, I want to hear you on your arguments. Why did you choose the cash position? It means not to distribute a dividend for 2 years, instead a kind of motivation policy, which is to create a kind of leverage on the decision of the potential shareholders to bring more cash.
Okay, so the reason that why we decide to forfeit the motivation for the investor is that because the current shareholder, the man is Mr. Vincent and the director, and I think under their expectation, rather get the motivation of the dividend back to themselves, they would like to have this more cash for the company to grow in order to capture the market opportunity, because it makes no sense if we pay the dividend for them and then we raise the equity in order for them to not losing control, then they get the cash and they get put it back to the company. So in the end, their first prioritization should be in order to remain cash for the company especially this company in the growing booming industry. So it should be a low dividend payout in order to reinvest and keep the company competitive advantage in order to remain leading in revenue. So that's why we think the dividend should not be a motivation for investor in this case, should not be a prioritization, should be not first prioritization, and on the other hand, should be more focused on the cash for the company.
Okay, fine. Second question on the dividend policy. When you start with a distribution of dividend, it means in year number 3, yeah, do you apply a constant payout ratio for the years to come, or do you increase the payout ratio when the cash flows or the net earnings increase?
Yep, it will increase when the cash flow increase. We not use the constant.
Okay.
So it's still be happy for the investor with the ratio. So if the company have more high cash flow in the year, for example, if the hypothesis go even better than the hypothesis 1, then they should be happy because we will not only give the constant payment, but we buy the ratio of the net income. So higher free cash flow, we give them higher dividend cap.
Okay, thank you. So another point, and I'm very glad you find this result, is on the 3 methods you use to value the company: book value, PE value, valuation, and cash flow valuation. And probably the most interesting element here is that the sensitivity of the value to the cash flow is very limited. And when you have a look to your results,
yes,
you can move to your table with the final results. And on the contrary, it's very sensitive to the level of earnings when we consider the PE approach, the method. So if I understand, it is part of one of an element of your conclusion, which is that the cash flow method, at least in that case, seems to be more appropriate than the PB or the PE approaches.
Yes,
that's correct.
Yes, sir. Because with the BE and BB method, that one of the key driver is depend on the PE ratio or the market value over book value ratio. It's more like a market benchmarking for the industry. In this case, that we know biotechnology is kind of very different because they have a very high investment plan in the next 5 years. Maybe not all the company operated in biotechnology sector that we operate and have the same thing as biotechnology. So we believe that the FCF method should be more appropriate and more convinced for the potential investor to believe in the pricing model is correct for the company.
Okay, and we have a slide on the screen right now, which is a sensitivity test, and could you comment? What do you think of the results you obtained here about the sensitivity of the final results to changes in a few percent modifications in the WACC?
So you wanted to comment from the WACC?
Yeah.
Yep. So
and the sensitivity analysis here.
Okay. Yep. So what is comes with the WACC that the yellow line that we think is see more higher probability that what will happen. In order for the WACC to go higher, that we will need to get higher of debt ratio, which we will not be able to maintain the debt over equity ratio as low as we can. This will bring to 13%. However, that with our equity raise, we believe that we will be able to keep it. So it's only happened for the WACC. We think it will go maximum up to 11.23%, and better case it will only 10.50%. So it's hard to go higher than 11.23%. That's the area for the WACC. And if we will have a net present value for different for hypothesis 1 and hypothesis 2 will be the role in net income, the change in the net income role. So we believe that the pricing value for this from this sensitivity that it will go around the color area that we highlight over here, as you can see. And this for me, I would take the average value of hypothesis 1 and hypothesis 2 as the pricing, the final price for the company event.
Okay, now I understand very well, you know, that here, when I have a look to your results, the final results are not very sensitive in the changes to the changes in the WACC, you know. If you compare, for example, the impact of changes in the WACC and changes in the level of earnings in the PE method, it's completely different, you know. It's much more sensitive in the PE method than it is here for the WACC scenarios, different scenarios you develop. So this is a very clear answer. Okay.
Thank you, Professor.
The second point is your last sentence. You said at the end, I got two values and I made the arithmetic average. How can you justify it?
Which one? This one? The recommendation.
No, your last sentence, you know, you said I got two values, and at the end, the value for the company is the arithmetic average of these two values.
I'm sorry, I couldn't hear you very clearly, Professor. Could you please repeat it?
Yeah, when you answer to my questions, you know, the last sentence, your last sentence was on how to find the value and the price, of course, the value of the company, the price of a share. And you said we have two different values, and at the end we choose a value which is the arithmetic average, the average, in fact, classical average, if you prefer. Yeah.
Yeah. Because what we believe is that if we use with hypothesis 1, it's too optimistic, and if we go with hypothesis 2, it's too like in worst scenario. So in this case, that it will be okay, because we did not know what will be the probability happen to hypothesis 1 and hypothesis 2. So we assume that 50% that the company will go into scenario 1 and 50% go to scenario 2. So if we go that, it will be like average of hypothesis 1 and hypothesis 2 value.
Okay, thank you. Last, could we come back to your recommendations to this black slide we have, you know, and could you explain that again, because I think it's very central in that case.
Yeah. So if you look closely at the way to calculate with the B over E or BB method, that we will only use the net earning or the book value of the current year. It was 2001. On the other hand, the FCF is the factor, the project, the future cash flow, and discount them back to the present value. So what I'm trying to point out here, that the B over BB or BE method is okay. However, that in this case, biotechnology case, that we do know with the high investment plan and the projected cash flow, is the book value and the net earning value is very fluctuated from 2001 to 2005. It will be, if we have more time, I will discuss more, but it will. This the way when the company do IPO, the different method they can use it. Also the timing. I believe that BE or BB method at the time that there may be if we're not urging go to IPO for 2001, there may be appropriate if we apply BE or BB method to do the valuation. For example, if the company want to operate to do IPO in 2003 or 2005. However, in this case, that FCFC more reliable for the company and also for to build trust with the potential investor to believe in the pricing model, because it will factor more accurately of this unique case of biotechnology.
Okay. Okay, thank you very much. Thank you for your answers. Thank you for your presentation. You know, do your colleagues of your groups first have some other comments, or is that is it all what you wanted to say?
Oh, well, I think that our representations have done really well his job, and this is our own results.
Yeah. Okay, so there's nothing else.
Thank you, Professor.
Okay. Yeah. Yes, I hear you. I don't know where you are right now. I lost you. I don't hear you anymore.
Yeah, I say thank you. If there are no questions, I'll leave the time for the next group then. Thank you so much.
Okay, thank you very much. So let's move to presentation number 2, which is by Ho Chi Minh City group number 1 also. Do you hear me?
Yeah, we hear you.
Fine. Are you ready?
Yeah. Thank you, Hanoi Group 1. We do appreciate your effort. And on behalf of Ho Chi Minh City Group 1, my name is Quang Nhật, and I would like to representative of our team members for the presentation today. And before we start in the presentation, I would like to say the apologize because we have the business vacation, so we don't have enough time for the presentation PowerPoint preparing. So we're just showing the report. But we do appreciate if you have any queries, we do appreciate to answer that.
You have more time afterwards, you know, to improve your slides and your report anyway. Okay.
Yeah. Yeah. Thank you. And next page, please. Firstly, I would like to introduce about the a short riff about the business overviews of a biotechnology company. This company was officially launched in 2000, and in 1990, the core business sector is manufacturing and delivering the instruments for biotechnology industries. And as a certain consequence, due to the characteristic in the industry, biotechnology is currently facing a slight competition in the French and Europe areas, because with this competitive advantage, it is also forecasted to change, and the biotechnology would face difficult challenges as there are numbers of multinational corporations willing to enter to the market. So the part of the management has implemented a strategic core planning that invests considerably into technology research and development to improve the qualification of the product, to maintain the current niche market share, as well as to satisfy the growing competition to scale up business. And next one, I would like to presenting about the financial analysis of with the historical balance sheet. For about the financial planning, so based on solely on the indicative forecasted cash flow, it is observed that the positive net working capital of these years will increase from 8.5 million in year 1998 to 15.72 million in year 2000. And secondly, with the total equity and liabilities that in 2000, there was about approximately 80,000 EUD. So with this financial structure, it is better after the increase in the level of long and medium-term debts rather in 2000. And so the debt to equity capital, debt to equity cap ratio, it could be increases close to 1 in order to maintain the development of the business. And next is I would like to present about the historical profit and loss. So with this P&L table, we observe that the sales also increased from about 31% from 1999 to 2000. And the profit also increased rapidly as the increase in sales. It was from 0.267 million in 1998 and to 17.38 million in 2000. With the investment plan and the financial plan, based on this analysis, we observed that in order to maintain and to rise in the capital structure, it could be diversified into 3 phases. with the first phase is we diluted the current shareholder for opening for the financial minority investor only, and it should be about 10% only. We still control the business and the business operation and management. So the board of management came up finally with 150 million EUD for the period of investment from 2001 to 2005. Therefore, this is a table that we analyze for the financial requirement, funding requirement with two hypotheses. So with these two hypotheses, it is observed that the forecasted cash flow of biotechnology in several hypotheses is considerable funding investment into CapEx and research and development category. The funding requirement for the first 2 years is about 60k EUD and 72k EUD for the phase 2. Certainly, there are two options that the board of management could take into account. Firstly, is to implement the equity financing strategy to dilute the current shareholders. And by implementing this strategy, the most advantage is the diversification and improvement of the business ecosystem, despite the negative impact for the earning per shares. So, for example, when the financial or strategic minority investor playing a role of complementing the core business or facilitate the internationalization to scale up the business, therefore increasing the trust and confidence for sustainable development. So, for the secondly, the option 2 is the company will implement only half of equity financing and half of debt financing for the total funding required for planning investment. So it is obvious that the total implementation of debt financing will increase interest cost, but financial distress or even bankruptcy of the company. But we do highly recommend the board of management to balance in both equity and debt financing.
But you, yeah, we will come back with questions on that table later. Okay.
Yeah. And so as we mentioned, we decide to recommend the POD for the financial policy. That is, in the procession, the revenue increases but the profit decreases. There's also some conflict, and it could due to the high depreciation of a new investment to CapEx. So for other side, by using the equity by issuing shares and decreasing the interest cost, it leads to the improve of profit, but fully use
total repayment 2.5 million euros. Total interest expense is
I don't hear you clearly.
Hello. So
Hello?
at the end of my presentation, and next is Mr. Tom will present about the evaluation methods and the conclusion of the report.
Okay.
Hi, Professor.
Hi.
Thank you for your presentation on the business overview and the financial plan of biotechnology company. I will going to present on the valuation methods we used for come up to a price per share for the company, and three methods that we mainly use to value biotechnology SAE. Firstly, discounted cash flow DCF method. The second method will be the multiple method, and the last one we will use the valuation based on method consideration. For the first method, discounted cash flow, the basic formula is quite simple, and the main task that we come up to that the valuation using DCF method, first we will calculate the cost of debt and then the cost of equity, and then we, based on the cost of debt and the cost of equity, we can have the weighted average cost of capital of biotechnology. As you can see here, we using the financial plan and the financial structure, we can have the capital method, capital cost of equity right here as shown on the plan, and based on the interest and the loan we have during the years, we can calculate the cost of debt having in the hypothesis 1 is around 8.64%, and for the hypothesis 2, it is nearly 9%. So the weighted average cost of capital in the present, we stand to value biotechnological is in 2001. And as you can see here, the weighted average cost of capital in hypothesis 1 is nearly 14%. And for hypothesis 2, it is around 18%. So based on that figure, we can, using the free cash flow discounted to 2000 to come up with the present value of the cash flow. And based on that, assuming that the company will have a terminal growth rate at 2005 at 1%, and the weighted average cost of capital at calculated above, we can come up to the enterprise value of around 100, nearly 200,000 euros. And yeah, and that is to say, based on that valuation, we calculate that in the hypothesis 1, the share value of the company is nearly around 39,000 euros per share. And we also do a sensitivity analysis. Well, like I just said, the first assumption of us is the terminal growth rate is around 1%. As you can see here, we have a different scenario for the terminal growth rate ranging from 1% to 2%, and the weighted average cost of capital in hypothesis as well will run from nearly 80.9% until 14.2%. And so based on that analysis, we can come up to a company valuation ranging from nearly 400 million euros to a little bit higher than 500 million euros. The exact number will be discussed with the investor when they make the investment, but that is the basic value that we think in our mind. And based on the same methodology, we can having the valuation of the company for the hypothesis 2 ranging from around 300 million euro to nearly 400 million euros. The second method we use to evaluate the company is multiple method. So we can have like just said, we can have the net earnings at year 2001, and in hypothesis 1 and 2 it's around like 11, no, a little bit higher than 11, but it is around that number, 11 million euros. And for the hypothesis 2, the net earnings in 2001 is around 4,600,000. So based on that, we can have the EPS, the earnings per share is around, in hypothesis 1, is around 100 and a little bit higher than 1,000 euro. And for hypothesis 2, it is much lower than hypothesis 1. It's around like 470,000 euro. So based on that, and the PE of biotechnology is around 12.5. And so based on that, we come up to the enterprise value of in hypothesis 1 is around like 145 million euro, and for hypothesis 2, it's just a little bit nearly 50 million euro. So what you can see is that the valuation of by using the multiple method is much lower than the DCF method. Or personally, I don't think that is a good valuation of biotechnology, and we don't think that we will use the multiple method to discuss a best valuation for the company. The last method we would like to mention here is the market to book value multiple. This is quite simple. This is based on the concept that we have a fixed value using to convert the book value of the company into the market consideration, and with a market to book value of 5.3, but and the book value of the company in 2001 is around 71,000 million euro, and for hypothesis 2 is in nearly 60 million euro. We come up to the enterprise value in hypothesis 1 is 375 million, and for hypothesis 2 it's a little bit higher than 300 million euro. For the last part, we would like to mention here is the conclusion. I think that for the pros and cons of each method, valuation method I have mentioned above, the DCF method is, I mean that it is quite technical, and it can be quite a robust method because it's based on the actual cash flow we use during the calculation, and it gives us the best amount for the valuation for the discussion and negotiation with the investor. For PE multiple and market multiple, I think that the advantage of the method is it is quite simple. It's quite simple for the investor to understand, and for the public to have to follow on the value of the company. But the quickness, of course, because this is quite complicated, it will be not an easy task for the analyst to understand how we come up to that number. For the market method, I think that the biggest disadvantage of this method is the subject to the market consideration, and it is will be much more volatile than the other methods. Yeah, I think that's all on part for the valuation and the consideration of the pros and cons of each valuation. Do you want to close this off, or to add anything to my presentation so that we can come up to the question and our discussion with the professor? Okay. I think if you don't have anything to add, we can welcome any questions to clarify any point in my presentation and your presentation, please.
Okay, thank you very much. The question, my first question is very simple. Right? You made a good presentation, like the Group Hanoi one, on the 3 main families of methods. But if you were the CFO of this company, what will be your final answer? You know, you are going to make an IPO tomorrow or the day after. What will be your price? The price of a share on the market?
I think basically I don't have a exact price for the IPO, but it will be the highest price that we possibly can reach. And of course, I will discuss with the bank to understand the market expectation on the the business prospect. I guess that price will be around it will be around the range from 300 million euro to 500 million euros. I think that this is that number come from the valuation per DCF method and the market method. So I guess that will be the price, the IPO price will be in that range. But I will discuss with my investment banker to understand. Ideally, I will wish to 500 million euros, but the list, the ceiling, the floor price we want is should be 300 million euros.
Okay, you said anyway, I will choose the highest price possible.
Yep.
You know that some professionals argue that this is not the best policy because you have to leave some potential profit for the investors, 10 or 15%, something like that. What do you think of this idea? I mean, if you choose the highest price possible, if according to your calculation, the highest price possible for the share is something like 100, for example. Will you choose 100, or will you choose something like 90, just because you want to leave some potential profit for those who accept to become shareholder of your company?
I think that is a quite interesting question, and which honestly we haven't looked into that further. I know that's the practice on the market. I know that they try to IPO at a price lower than the best price, the highest price they can quote to leave some room for the new investor to come and to enjoy some increase in the price. But I don't think that would be a fair decision for the existing and the current shareholder. You know that they have the right to enjoy the best price, and I just said, it will much depend on my discussion with the investment banker to understand the market prospect. If they don't really, if they don't estimate the true value of my company well, I don't think that I should leave any room for that investor, and I will try to reach the best, the highest possible price that I can on the IPO.
Okay, in your sensitivity analysis and calculation, what is, in your opinion, the most important element parameter of viable?
I think that it should be the weighted average cost of capital. You know that it will theoretically it will be very hard. It will be very difficult to estimate the terminal growth rate, and the only concrete element that we can calculate here is the weighted average cost of capital based on the business performance of the company. So I think that it would be the most important element in our sensitivity analysis.
What is your opinion on the terminal value calculation as you do it and as it is done in most of the textbooks? Do you think it is correct?
Yeah, please go on. Sorry, I haven't.
Yeah, do you think it's there is a bias in the calculation? It's kind of proxy, but not a very good proxy. What do you think of this value, which is integrated in our calculation afterwards?
I think that it's not for me personally. For me, what I read, I don't think that they represent you know, they just what I understand here is that they based on the assumption that the business or the company will continue to grow in the future, and you don't know what the future will become, so you just give that a value. It could be 1%, it could be 2%, but the assumption is that the company will continue to grow, and because that is the assumption, the assumption here is not quite very strong, because you know we are engaging in a very volatile business, and it could be have much more competitor to come in the future, so that there is no guarantee that our business will continue to grow just like as any other business, because if it continues to grow, it will be attract very much a market player into our same business. So I don't think that assumption is quite strong. What I mean here is that you cannot expect the company and the business continue to grow forever.
Okay, could we come back on your last slide, which is very specific, you know, and different from the others? Yeah. Could you explain again what is your argument and what are your conclusions here?
Yeah, basically we are mentioning here the pro and cons between how we find the new capital for the financial needs of the company, and I think that thank you, please add it here. I'm quite sure that follow the impact on the control of the current shareholder here.
Your question is about control. It's more a question about control dilution than anything else.
I think this is the part loose end that I haven't have a chance to discuss with my partner and my teammate. I think let's try to look at it again in our final draft, and I think I will provide a more comprehensive discussion on this, please, Professor.
Okay, so perhaps we can come back, you know, on that question at the end of the presentation. Huh?
Really appreciate
good argument, yeah.
Thank you.
So thank you very much for this presentation anyway. And
thank you, Professor.
And it's really time to move to presentation number 3. And presentation number 3, as it is scheduled, you know, it's for Hanoi Group number 3. Hanoi Group number 3. I hope it is this group is ready right now. I see your slide. That's great. I don't hear you, but I see your slide.
Yes, we are here.
Hi, here you are. Fine. That's good news. So you can start whenever you want. The floor is yours.
Yeah, thank you, Professor. Good afternoon, Professor. Good evening, MBBS 13. Yeah. We are Group Hanoi number 3, and we were discussing about the biotechnology SA case. Firstly, I will give a brief introduction about the company. Biotechnology SA was founded in 1990 by Mr. Vincent. The French firm majors in manufacturing and selling instruments for the biotechnological industry, and being the market leader when working with large corporations such as Lafarge, LVMH, VSM, and other small firms. We will take a SWOT analysis on the company. Firstly, about the strengths. The company is being the leader in both regional and international markets. Secondly, the company have diversified customer base. About the financial position, most of their financial ratio are positive and continue growing in recent years. Fourthly, they have a centralized shareholder structure, and the last strength of the company is they have a high dividend payout ratio, attracting Hello. Yeah.
Okay, yes, I hear you. On these
Yeah,
different points,
I hear
yeah.
some echo. Okay. And accordingly, they have great opportunities, such as they are operating in a field that having great potential and high barriers for future competitors to achieve. Secondly, there are not many competitors currently. They have the potential market with growing and diversifying demand. And the last opportunity they can have is that they are trying to expand to foreign markets, such as USA and Southeast Asia. However, they have some weaknesses that they have their research and development division is quite weak. Secondly, in the financial position, their debts and especially long and medium term debts are climbing over years. And lastly, they are under high pressure to increase equity for future investment. And accordingly, they are facing two main threats. The first one is possible multinational competitors and the rapid technological changes in the field. Yeah, and we have analyzed the strengths and weaknesses of the business and its financial position. And hereafter we shall estimate the value of the company in the year 2001 and employing the data from previous analysis under two valuation methods. The first one is multiples based model that we are basing on the income statement. And the second method is the future flow models basing on the free cash flow. To come up with the valuation method, we have some assumption. But the first one, we will take the tax rate of 30%. In the calculation by using the PP ratio, we use the book value in the year 2000 and the ratio of market to book value, which is assumption for the market in exhibit number 1. In the calculation by using the BE ratio, we use the net earnings in the year 2000 and the ratio of price over earnings is assumed in the exhibit number 1. And the market to book ratio shows the value of the historical cost. In this case, the value of the firm exceeds 5.3 times to the book value. And the last but not least, regarding to the payout policy, the company plans to distribute at least 25 million euros as dividend from 2001 to 2005. In the optimistic hypothesis number 1, the annual earnings were expected to ensure the payout policy throughout 5 years, and the gross margin is higher, so the investment is efficient and should be the priority. So the firm decides to have no dividend payout in the first 3 years and pay totally 25 million euros in the last 2 years. And on the other hand, in the realistic hypothesis number 2, the net income was forecasted to not accommodate the payout ratio. Therefore, the firm decides to make dividend payment annually since 2001 to maximize the benefit for the shareholders. Okay, so I will move on to the valuation. I will give to Ms. Trần Thanh Trung for the valuation by multiples.
Okay.
Yeah.
In this valuation by comparables method, according to the PP, the value of firm is calculated by the PP plus multiples the book value, in which the book value, the PP ratio is equal to 5.3 shown in the exhibit 1, and the book value as of 2001 is estimated based on the choice of fund to meet the financial needs in the coming years for new investment plans of the company. We have the book value of the hypothesis 1 and hypothesis 2 is the 50.04 million and 52.04 million euros accordingly. In hypothesis 1, thanks to the high retained earnings and accumulated earnings, we need only 3.27 million euros new equity and 24 million euro in. So the book value is thus only 50.04 million euros, which equals to 36.77 accumulated retained earnings plus 10 existing equity plus 3.27 new equity. As mentioned above, we assume that we don't pay dividend from 2001 to 2003. In hypothesis 2, the accumulated retained earnings is lower, just only 23.69 billion euros due to the lower retained earnings. So the company must raise higher new equity for 18.35 million euros, while new debt increased more 22 millions of euro to maintain the 91% of DE ratio. We choose the DE ratio in this hypothesis is lower than hypothesis 1 for fear of the liquidity risk. Thus, the book value in 2001 is a 52.04 million euros in hypothesis 2. After calculated the book value with the PB ratio 5.3, we have the market value in hypothesis 1 and hypothesis 2 is the 265.21 and 275.81 accordingly. According to the PE multiples, the value of firm is equals to the net earnings plus the PE ratio. Applying to the PE multiples of the firm, we calculate as the data below. The net earnings in the year 2001 is calculated in the sheet income statement. In hypothesis 1, is more optimistic than hypothesis 2 thanks to the higher net income. In hypothesis 1, in the first three years, as mentioned above, no dividend payout, but the shareholders received total 25 million euros as committed in the last 2 years. However, in the hypothesis 2, the net income estimated is much lower and not enough to complete the payout policies. After calculating the net earnings in 2001, we have the value of firm is 165.88 and only 64.88 in hypothesis 2. In terms of PB method of value of the firm in hypothesis 1 is lower than in hypothesis 2, while in terms of PE method, value of the firm in hypothesis 1 is higher than the hypothesis of 2. In terms of the PB method, it gives an easy way to determine the value of the company. However, this method completely ignores intangible assets such as brand name, goodwill, patents, or other advantages created by the company. The book value also does not reflect interior problems inside company that may carry high debt levels or sustain loss or possible liquidity risks. They may create artificially higher PB values. So we have this market approach has some advantage, such as it is a direct approach for establishing the fair market value and grounded in real public data and does not rely on subjective forecast. While they also have some disadvantage such as it is difficult to find suitable company and transaction to make comparisons, and it is difficult to ascertain that market data is accurate and consistent. So with this market approach, we recommend that this method most appropriate with in case where the company operates in a stable business environment and already has a sustainable operating morals and there is enough comparable companies and transactions. There's enough available market data, and this data must consistent and reliable. And next, we will talk about the valuation. Mr. Hiếu will talk about the valuation by discounted cash flow estimation model.
Good evening, Professor and everyone. So for the discounted cash flow approach, so I would like to go through the advantage and disadvantage first. So for the advantage of this model that we can be used for the company with various types and stage that you see. And for this approach simulate the market price, and even there is no active markets, we can also apply this. It's also the second advantage of the models. And it's also very helpful for the value on the company's tangible and intangible assets. However, some disadvantages kind of the difficult to calculate a sustainable profit stream, or especially that difficult to choose the capitalization and discount rate. And most appropriate for this model is it is only methods able to calculate for the company intangible assets, and this is the last amount of the data in regarding past and futures earnings. So I'll come back to the page number 7. Okay. For the free cash flow discounting model, that we will take into account value of firm by calculating the present values from 2001 and 2005 cash flow, and plus with the terminal values of the firm. So to calculate that, we need to identify the WACC by calculate the cost of equity and cost of capital, cost of equity and cost of debt. So based on the market value, and we have the cost of equity, as you see that take into account beta is 1.6 and market risk premium is 6%, and we have the equity is around 15%. And for the cost of debt, based on the loan repayment table, we have the total interest of the 2001 is 2.5 million euros, and loan outstanding is around 25.5. And we have the after tax cost of debt is around 6.99%. And with assumption to fair comparison among the hypothesis 1 and 2, I assume that there are no retail earnings to be counted on the WACC calculation. And as you see on the bottom left table, we have the calculation for WACC is 11.54%. Will be applied for both hypothesis 1 and 2. And in the next page, for second step to calculate that with same WACC is 11.54%. We calculate the NPV for hypothesis 1 is 104.95 million euros, and hypothesis 2 is 84.4 million euros. And as I explained before, the dividend payout policy that in the hypothesis 1, there are no dividend payment for first 3 years, because we foresee that the net income is for this 5-year period is totally higher than the 25 millions, and we try to get all the retail earning for first 3 years, because this is a very heavy investment period. And to do that, we can support much of all the investments and cash flow, and after that we still can complete the payout policy mission that we pay out for the last 2 years. And for the hypothesis 2, the dividend payment that we foresee we cannot accommodate for a whole 5-year policy. That's why we have to pay as much as possible to encourage the investor from the 2001. That's why we have to pay out immediately with 5 million on 2001. And after that, 22 and 23, because of heavy investment, we cannot, we have a negative net income, so we cannot pay out anything. And after that, we have pay out own for the last 2 years. Okay, so let me move next to the second page. on the calculations of the firm, we will calculate the terminal value of the firm in 2006. And we assume that in the 2006, when we stop, that we have the growth rate is only 0%. And we still apply the WACC is the 11.54%. So we have the cash flows of 2006 and 2006 for both H1 and hypothesis 1 and hypothesis 2 is the same as the 2005 free cash flow. So discounted the terminal value, we have the value of firm for hypothesis 1 is 202 millions, and hypothesis 2 is 170 million euros. So the value of the hypothesis 1 is higher than 2 because 2 reasons. First one is the hypothesis 1 have very optimistic gross net incomes, and why the hypothesis 2 is a very conservative ones. And the as sharing that because of the dividend payment payout policy, and how can I say, the hypothesis 2, the net income cannot accommodate for 25 million euro per payout policy. That's why the discount rate and the value of firm is H1 is higher than H2, and we have the share pricing is 2 euro for H1 and 1.71 for the hypothesis 2. Okay, in next page, we conduct some sensitivity analysis for the WACC movement between from 10 to 13%. So in the middle is the 15.5% is a highly possibility of the firm running, and we foresee that the in the changing of WACC, it is when WACC is reducing, so the changing of firm in both of the terminal value of firm and NPV is increasing in contract with the WACC movement. And for the value of firm is almost increased slightly with the ratio of the WACC changing. However, the NPV, the changing is maybe 1/4 of the movement of the WACC changing. So next we move to the pros and cons comment for the valuation method. I would like to invite Ms. Hằng for their some comment. Thanks.
Hello, Professor.
Yeah.
I will talk about the part 3, weighting different methods to determine value.
Yeah. I hear you.
There are different methods we can use to evaluate a company's share price. Each of the approaches use different data to estimate the value of the company, which result in slightly disparity between the outcomes. Summaries of valuation results are presented above. The price per share of biotechnology SA determined by the method, ranging from the 1.66% to 2.65% in hypothesis 1, and from 0.65% to 2.76% in hypothesis 2. According to the different equity investment purpose, investor can independently use the result of the valuation method. And as you can see in the slide, the advantage as well as the disadvantage of two methods with the market approach with the PE and PB, and the income approach with DCF method. For investor from the long-term perspective, the discount cash flow valuation method will provide user with a greater reliability. For investor with an investment view of market volatility, multiple player valuation method will be considered. In the case of neutral investor may establish a price that is weighted average of the valuation method that establishes a particular acceptable price. For IPO purpose, we need to consider weighted of different methods to determine one price value of a share. In our point of view, with the situations of the company biotechnology SA, biotechnology is a private company with a high investment rate and high growth rate. There aren't many competitors currently, and potential market with a growing and diversifying demand. And we have the characteristics of the available data. We determine the proportions of the PB, PE, and discounted FCF method to be 20, and 60% respectively. And as you can see in the slide, when we weighted at about the fair value of the company is 2.50 euro per share in hypothesis 1 and 1.77 euro per share in hypothesis 2.
Okay, in the last section, we will see the firm should or shouldn't go for IPO. In terms of advantage, the firm has 7 advantages for go for the IPO. The first one is the increased total equity. The second one is reducing corporate debt. Well, public companies may retire debt through the IPO to reduce the interest cost and improve cash flow and their debt to equity ratio. The third one is for the higher valuation. In short term, companies that have their shares listed on the stock exchange have investors competing with one another to invest in them. As a result of this competition, the price of the shares is driven higher in short term. Sometimes the price go abnormally high. However, in long term, the price reflects the true valuation of the firm. The fourth process is the easier for access to funding via issuing stocks. Unlike private limited companies whom investors are locked in within the company, investors of a public company can enter and exit the investment at their own convenience. The liquidity of the stock exchange markets makes the investor willing to part with cash more easily, because whenever an investor wants to sell their investment, they can do so, and there will always be someone else willing to buy. However, companies listed on the exchange market have more access to capital and therefore more opportunities. The company will also be able to have a proactive cash flow plan. The company will have a proactive cash flow plan, diversifying funding resources with low capital cost and not being dependent on the bank. The sixth advantage is increased prominence. Companies going through an IPO are more recognizable and gain the attention of the potential customer and new strategic partners through the press release and financial media coverage. However, when the company gets listed, all its stakeholders, including its suppliers and employees, start viewing it with more respect. Therefore, public company can attract and retain talented employees. And the last advantage for going IPO is strengthen transparency of the corporate governance. On the other hand, about the disadvantage of the IPO on the stock exchange, the first one is about the loss of control, dilute the ownership by decreasing the stake of current shareholders. So promoters tend to lose control over the workings of the corporation. Besides, loss of business control may lead to some operational risks. The second one is loss of privacy. The more information a company gives out about itself, the more competitors can find out about the inner workings and the strategy being followed. Going public may make a company lose its competitive edge, especially if its edge is based on withholding certain information from their shareholders. The third disadvantage is about the performance pressure. Executives of a publicly traded companies face intense pressure to keep their stock price high in the face of market volatility. They may not be able to make bold moves if such moves negatively impact the stock pricing. Pressure to short-term performance from shareholder. Meanwhile, the biotechnology firm need more time to return due to the long-term investment. And the fourth one is undervalued. Company can be evaluated due to the market performance that directly affect the stock price. Sometimes to ensure the requirement for listing, company may have reduced the payout ratio, which can make price maybe less attractive in the market. Next one is cost of compliance for stringent standards and increased administrative work. Company listed on the stock exchange may spend an enormous amount of money and paperwork to comply with the stringent regulation, incur periodically over the company lifetime. And the last one, the reason that the company shouldn't go for IPO because they will increase the initial cost. The IPO process is expensive, lengthy, and time-consuming process, and company may face with risk of not completing the IPO process. So in conclusion, the company needs to think carefully about the timing and pricing before IPO. IPO is a crucial change, but if IPO is too early, the corporate governance is uncertain. It may lead to many failures and risk for the company later. That's all. That's all for the presentation of group handout number 3. Thanks for listening. However, we have some technical issues, so thank you very much.
Okay, thank you very much. Just a few questions before moving further.
Yeah.
The first question is about the weights you used. In your calculation, you have these 20, 60% weights. How did you find that?
Dear Professor, thank you for the questions. The weight 20, 20, and 60, we collected several real data from previous company in the same sector. So we use DCF as a main method. So we weighted is highest, and other method PE and PB is sum up of 40% is the second method we use, and the weighted that we collected from the real data of previous company in the same sectors.
Okay, you have a table to calculate the free cash flows as we did with in the Sanofi case. Could you come back on this table, please? Yeah. How did you design the table? What were the most difficult points to design the table?
I think the most difficult part for this to create this table is how to identify the dividend payout policy, and to come up with this idea, we have to think about how maximize the free cash flow we want, and how we want to implement the payout policy for the company. And we also have the data for the net income forecast for first 5 years. So for both the hypothesis 1 and hypothesis 2, we have balanced this between the dividend payout policy with the free cash flow of the company. And based on that, we decide the dividend payout policy, no payout for hypothesis 1 with first 3 years. But for the hypothesis 2, because total net income for 5 years only 20 million, so we have to maximize the payout for the investor. That's why we have to pay out since from the first years.
Okay, fine. On last question, perhaps, because we have to move. On the last slide, you have a pros and cons. Okay. What is your argument? Do you think that pros are more important than the cons, and this difference is a good summary of the situation and explanation of the fact a company like this one, like biotechnology, wants to make an IPO? Or do you think that in some cases cons are higher than pros?
In that case, we have the pros and cons of IPO. As we talk in conclusions, IPO is a crucial trend, and nowadays, if the company want to get to raise capital, the company can usually IPO. But before we do IPO, we have to think carefully about the governance, corporate governance, because it's a very important factors. And besides that, we have to think carefully about the pricing. As we talk about the pricing of the company before IPO, because if we undervaluated or the price is not attractive to the investor, then IPO can go the values. So in conclusions, we recommend to the biotechnology to think carefully about the timing and the pricing before IPO.
Okay, fine. So thank you very much, for this third presentation, and to the three groups which were on the floor. Let's have 4 minutes break, very short break, because we are late, and we start just after with the fourth presentation by Ho Chi Minh City HCMC number 3. Okay. 4 minutes.
Thank you, Professor. Yeah, thank you, Professor.
Thank you very much.
Thank you.
Okay. Ils sont prêts, ça va. On va y aller. Okay, I'm ready again. If you are ready, all of you, we can start. And group 3 from Kevin City, the floor is yours when you want.
Hi, Professor. Can you
Yeah.
hear me?
Yeah, I hear you clearly.
Yeah. I hope that you can see my screen now.
I see your first slide with your names and November 22nd. Yeah.
Yeah. Hi. Hello. I'm Hiền. I'm from the group 3 of Ho Chi Minh City. So
Yes,
today I would
that.
like, yeah. Hi. Yes. So today I would like to present our analysis on biotechnology as a case study. What we focus is on the stock valuation of biotechnology based on the information which we receive from your.
Yeah.
Firstly, I think the summary of biotechnology case is largely shared by the group, but I would like to walk through. They are a new company which have been established about 10 years until if you take it like today is 2000, so it's just 10 years. Their customer is mainly fairly diversified from large corporation, small industry, and some research laboratory. And they have also have not just the market in France, but also have the export market to European, and they have a fast growing to South Asian country. And about the biotechnology industry is an industry requires a huge investment due to the rapid technology change. Therefore, the company always need to have heavily investment on research and development. So the effort of their R&D activity could help them to be the market leader in this sector. About the equity structure of the company, so the company, this company have a quite stable group of stakeholder with only three part of stakeholder. First is Mr. Vincent, who are holding 60% equity of the company, and he is also the founder. The rest is shared by other director of the company, 10%, and 30% is from a venture capital organization. So what the desire of the company holder is that they want to invest on their company more and grow more in the future, in the next 5 years. However, they also afraid on the dilution, the control dilution, and other fears when they go public or issue new share. So we need to focus on that desire from stakeholder.
Mm-hmm.
Yeah. Regarding to the SWOT analysis, so largely we can say that their strength is that they have a very high growth rate in the last few years, and their markets is very promising. Their weakness is on the investment cost. It's really high investment cost, and they are still pretty new. They are the high capital cost is also a big challenge because the company is just established for about 10 years, and it is the new industry. So the debtor always require a really high interest rate on whatever they lending to the company. About the opportunity, they have very promising future when they can expand their business to other country, as well as biotechnology is the new industry. So there's much more room to grow in the future. The threat is more about other competitive can jump into the market in the near future, as well as they are lack of public awareness about the market is lack of public awareness about technology issue, and the European regulation is very complex, which is and will be more tightened over time due to what related to biotechnology product. Then we have a quick summary about the financial condition of biotechnology until today, 2000. I will not go through the full financial statement, but I just sum up a few criteria. The first is that they have a high investment rate and high growth rate. The second is they have very low debt capacity. As you can see here, the debt capacity is very low due to the total equity, the medium and long-term debt over total equity rate is very low. So debt capacity for 2021, for example, is just $6 million, €6 million. So there's a big challenge. The third point is the high return for shareholder. The fourth one is an unstable dividend policy. Currently, we are seeing a conflict between the CFO and the company owner, who both of them have different view on the dividend policy of the company. And the fifth is what I have shared just now. They have a stable shareholder group and they would like to maintain it. After going through the financial statement and the company condition at the moment, we see that in the case of the free cash flow and the cash available for the next 5 years in the both scenario, hypothesis 1 and hypothesis 2 is very negative. They are lack of cash for the next 5 years, and whatever happened, they need to have more money to guarantee for their operation as well as the investment plan. So in order to raise new, in order to get new cash for operation, there's always two ways. One is debt issuance and one is equity issuance. Each of them have pros and cons. For example, if you borrow debt, it will be cheaper than issue equity, and it's also have to guarantee the desire of company stakeholder to not to avoid the dilution, the control dilution. However, consider the debt capacity of this company. We can see that fully borrow the new money for the next 5 years is not a choice, because the debt capacity is very low. So we have to consider a hybrid option to mix between debt and issue new equity. So there's a two way we can do it. The first is that we borrow debt in 2021 first, then we issue more equity from 2022 and so on. The second way is that we issue the common equity first in 2021 and borrow more debt from 2022 to cover the financial need for 2022 and 2023. So we highly recommend the second way, to issue the common equity in 2021, then borrow the debt in 2022. There are some reasons about our recommendation. The first is that our leverage ratio is remain at reasonable level with the D on E. The debt on equity is remain under 70% during the period of from 2021 to 2025. The second is that the company is still under control for the current shareholder after the IPO or issuing new share. The priority will also given to the existing shareholder when we issue new share. The third is that because we can see that the cash condition, cash flow condition of this company is really weak for the next 5 years. So in order to guarantee the original financial plan to have a dividend in the next 5 years equally is not possible. So we decided that we will not pay dividend until the years of 2023, and we will start to pay dividend on 2024. And in order to satisfy the shareholder, the old shareholder and the new shareholder, we will increase the dividend payout from 25 million to 30 million, equally dividend for 2024 and 2025. Okay, so this is the new financial statement after raising the capital. We can see that we have the dividend paid in 2024 and 2025. Each year is $15 million, and the net income is positive in 5 years. Is the next 5 year in the hypothesis 1, and it will be negative in year 2 and year 3 in hypothesis 2, which is more conservative.
Mm-hmm.
Yeah.
Right.
Yeah. So operational assumption for biotechnology after we issue new share, that we have the peak sale is about 227K in a million in 2025. This is a peak sale. The original operating margin is declined from 16% to 2.3% in 2022, then rise back to 12% in 2025. In consensus case, which means hypothesis 2, this is more negative. It is dropped from 7.7% to negative 0.7%, then rise back to 8.2% in 2025. The WACC, actually not like other group, they use the same WACC for the next 5 years. We consider the expectation on expected return on the market is changing. We have the assumption that the expectation return on the market will raise 10% in 2021 and 5% for the next 4 years. So the WACC is also increased in the next 5 years from 40% to 70 or 90%. We also calculate an exit plan for the stakeholder in case they want to sell back the share for the company. We will use the terminal value, terminal growth rate in the future after 5 years is 2% per year. Why we come up with the 2%? This is the interest. I mean the inflation rate we take from French market from 2000 and 2005. So by our methodology of calculation, the implied share price will be above 688 euro in management case and 507 euro in consensus case. So in detail how we calculate it, please go to the next slide. So we are using 3 different methodology to calculate, to evaluate the company share. The first is the PE, second is PB, and the third is DCF. So PE and PB methodology is mostly calculated based on the market benchmark. We use the PE and PB ratio from the market information. So these two methodology will provide us like an average or a fair price, which other country in the same sector is valued. However, it's just not taken into account the specific condition of the company, as well as what is the future, the forward-looking future of the company in the next 5 years, 5 or 7 years, something like that. So this is what we consider as a benchmark for our company valuation methodology. Our main methodology will be DCF. So in DCF method, we use the new cash flow, which have been calculation after issuing new share. Then we, as you can see, the free cash flow for firm in 2021 and 2022 is negative, and it will start to be positive in the last 3 years. For the WACC, I don't know if you can see the last row. Okay. For the yeah, okay. For the WACC,
last one is WACC. It's a WACC calculation.
Yeah. For the WACC, as we have explained before, we expect that the RM, the market return is increased over the years, and the debt on equity ratio also difference over the years. Therefore, we calculate different WACC over 5 years. We also have already calculated like consist WACC, which is 11.5%, same as other group. However, this our methodology is more conservative. It's taken into account the inflation as well as the change in expectation from the market. So we believe that with this methodology, we will attract the investor better with the fair valuation. So after apply the beside apply the WACC on the free cash flow to calculate the PV of the free cash flow, we also taken into account the terminal value of stable growth after 2025 as an existed plan. Then the PV for terminal value is about 87% in after discounted to back to the year 0. Then to be summarized, the valuation method for both present value of cash flow and the terminal value, the enterprise value would be 96 million in hypothesis 1 and 78 million in hypothesis 2, which implies the share price is about 688 euro for hypothesis 1 and 508 for hypothesis 2. This is fairly lower than the market benchmark, which we have calculated by PE and PB methodology. That's why we hopefully we think that the company share would be very attractive on the market. So we can like choose the best investor for the company. In the next slide, we do a sensitivity analysis on the DCF methodology. What the variable we consider is the perpetuity growth rate, which we have set is 2% previously, and also the risk-free rate, which we have set as 5.4% previously. The risk-free rate can range from 5% to 6.5% as per the assumption you give, and the perpetuity growth rate will be range from 1.5% to 3%. So fairly, the value of share could be ranged from 607 and 37 euro to 800 to 825 euro in hypothesis 1, and it will range from 487 euro to 569 euro in hypothesis 2. So our current valuation is really at the middle of the range. So to conclude our valuation, we can see that at the current level, biotechnology is pretty. I actually use the undervalue is not the right word. Actually, it should say that the company share is pretty cheap compared to other company in the market. Yeah, and the second is that biotechnology have very promising portfolio, have a pricing power, market position, which could make it attractive stock and allow us to achieve a higher valuation in the future. The third is that with such strategy, biotechnology can maximize the shareholder value, expand its geographic reach, distribution channel, acquire more resources and future research, and also M&A activity. The M&A activity we are mentioning here is the opportunity to buy a new distribution channel in Germany, which we saw from the assumption is very promising. So maybe after we raise the new capital, we can consider about invest in that channel. And in order to avoid the control dilution issue, which the shareholder is very concerned, we have some way to avoid it. The first is the capital raising for existing shareholder. We have three key of stakeholder, and we can issue new share for just those shareholder. The second is issue the preferable stock, which means we issue a new stock to a new shareholder, but they would not have the voting rights. The third way is issue the callable stock, which means that after predefined period, the company will have the right to call back and to buy back those stock, which will retain the stakeholder structure of this company. So that's all of our presentation. I hope that you enjoy it, and I'm waiting for the question.
Okay, thank you very much for this very good presentation. Could you come back on your calculations with the PE and PB method?
Yep.
How do you explain that in both hypotheses you find the same share price?
Yes, as I have just said, because this methodology is mostly based on the benchmark of the market, so we would like to keep it the same for two hypotheses.
Okay. On the last slide, do you really think that to get new shareholders, if you have that's a minority shareholder, perhaps a small majority, something like 20%, is good news or bad news?
I think that depends because in case the current shareholder, especially the company holder, he have a big concern about the company control and the dilution, the control dilution. So having a little new stakeholder will be a good news. However, in the strategy thinking, I think this company will need a strategic partner, because it's going to expand a lot in the next 5 years. Then they will need someone to help Mr. Vincent to help to grow the company. Currently, we can see that there's a lot of room for growing, a lot of room for optimized in this company, especially like the inventory or payable or like payable ratio or something like that. We see there's a lot of room, as well as we see that the way this company is controlling their cash flow is not as good as it should. They are borrowing the money with very high rate, like 11 or 11.5% is extremely high comparing to the French market. So in case we have a strategic partner who could have to bring more capital, or who could have to expand to another market, or who could have to bring the new loan with the lower interest rate, it would be the good news for the company.
Okay.
Yeah.
The arguments could be also the fact that if you are listed on the market and you have few percent of individual shareholders, liquidity level will increase, and as we know, liquidity is a factor of value creation. And the second one is the fact that if you have some very well-known investment fund, for example, taking a stake of your equity, it brings you a better image, and image improvement has also a value. You have a calculation, but you have these dimensions also to take into account. Okay. Could you come back on your dividend hypothesis? You have only one, as far as I understand.
Yeah.
Yeah, it is the same. Yeah. So your argument is a cash argument. It means you think that in the first 3 years you don't have enough cash to make a distribution. You need to keep the cash, and after cash flows are strong enough in order to justify a dividend paid every year to the shareholders. But it seems that dividends are stable after that in terms of amount. It's not a constant payout ratio. It's stable in terms of monetary unit. That's correct. How do you explain that?
Sorry, can you come again with the question?
Yeah, it seems that we agree that you start again only with a dividend policy, in fact, different from 0 on your 3, on your 4. But after that, as far as I understand, your dividends are constant. Is that correct?
Yeah, our dividend.
Surprised. I was waiting for an increase in terms of monetary unit, because your payout ratio, for example, is constant, or because the dividend policy will follow the increase of the cash flow, or will follow the increase of the sales level.
On the question, I think because during the first 5 years, we have to invest in some projects as well as some fixed assets. So that's the reason the dividend is not constant, and that fluctuates during the first 5 years. But after 2005, I think the cash flow will be generated constantly and have a little bit high growth, stable growth during the period from 2006 forward. So I think after 2005, the dividend payout will be will be under the growth, steady growth rate.
Okay. Okay, thank you very much for this presentation, for the answers to my question. And now we will move to the next presentation, which is presentation number 4 by Hanoi Group number 5, please.
Thank you.
Thank you. The floor is yours now, Hanoi Group number 5. When you are ready, you can start with your presentation. Yeah. I see your slide.
So hi everyone. We are
hi.
Hi Professor. Hi everyone. Well, we are Group 5 in Hanoi, and we are 4 members: Nguyễn Hiếu Nghĩa, Phan Quốc Đông, Nguyễn Thanh Kim Dung, Nguyễn Thị Ngọc Ánh. So we are the cost of company evaluation and on the case study of biotechnology SA. So now we make a few summarize on the situation of the company. The biotechnology manufactures and sells instruments for biotechnological industry since 1990. The company works in a high growth sector with very little competition at the French and international level. The situation can change rapidly as some of the multinational companies are considering entering the field. The company growth rate in the years of 2000 is about 74%. The high growth situation will continue for about 10 more years with the expected growth rate from 20% to 30%. Biotechnology must diversify activities and invest heavily to meet the growing demands. The company firstly invests in Germany to start a subsidiary, then to the European market, and finally America and South Asia. At the same time, the company must contract a new research center equipped with the latest materials and technologies to maintain technological superiority. The company intends to invest 150 million euros for the periods of 2001 to 2005. As regards the expected incomes, the company has decided to work on the basis of 2 hypotheses. About the company valuation analysis overview, we are now doing on company valuation analysis to propose to the board of directors. The analysis is done for both hypotheses. Each includes several aspects. First, forecast future cash flow. The second is financial policy. Because cash flows are not sufficient to cover the funding needs in a high growth situation, the financial directors suggest to increase in equity base, but the CEO fears that losing the control of the company could lead to serious management problems. The third, company valuation. We have 4 methods of SIPO model, book value model, market to book value model, and future cash flow model, both free cash flow based and dividend based. About the IPO, we show our opinions on the IPO and valuation of the IPO. About the sensitivity analysis, how the change of tax rate, interest rate, and dividend growth rate will affect the value of the firm. About aspect of debt and depreciation plan, the first analysis is the debt repayment and depreciation plan. About the debt repayment table, there are currently 5 outstanding loans in the years of 2001. The payment methods are constant repayment, which means that the debt repayment expense stays the same years after years. The total payment and interest expense decrease over time. The first four loans had the maturities of 10 years. The last in 2000 has maturities of 3 years. The outstanding total debt balance at the end of the year 2001 is 25.5 million euros. The total debt repayment is 2.5 million euros. The total interest expense is 2.545 million euros. About the depreciation, capital expenditures of the company is 46 million euros in 2001 and 8 million euros in 2005. So the CapEx includes construction, equipment for research center, equipment for new production, equipment for existing manufacturing. Depreciation methods is the trade-like method. The construction depreciation period is 20 years. 40% of the equipment, which is ordinary material and equipment, depreciation period is for 5 years. The other is about 60%. Sophisticated materials and equipment, depreciation period is about 3 years. Depreciation on investment of previous assets is 5 million euros each year during periods of 2001 to 2005. The total depreciation is at around 20 to 30 million euros per year.
So I would like to walk you through hypothesis 1. The first analysis is the cost of capital. We use capital asset pricing model to calculate the cost of equity. Market risk premium is 6% in 1998, increasing to 10% in 2000, and go up to 15% from 2001. The beta is 1.6 in 2000, 1.8 in 2003, and 1.9 in 2005. To calculate cost of capital, we use weighted average cost of capital. The WACC in 2000 is 16% and reached 19.7% in 2004. With the assumption of sales growth rate from 2005 to 2010 is 20%, depreciation stays the same from 2005 and is equal to investment. In this table, we calculate the following factors. The first one is the net income. That interest expense already include interest on new debt incurred by finance policy. Net income negative in year 2003. Secondly, cash flow from operation by adding back depreciation and minor change in working capital. And the last one is cash flow from investment, includes capex and equity participation. So with all the calculation, free cash flow are negative in 2001, 2002, with the value minus 24 and minus 19 million euros respectively, and positive, going positive from 2003. Discounted cash flow rate is 16%. That is the WACC in year 2000 because our point of view in 2001. From 2011 onwards, forecast cash flow growth rate is 4.68%. That is average French inflation rate from 1960 to 2010, and valuation model is growing capacities. From ownable NPV is 213 million euros. IRR is 31.77%, which is really high compared to normal business. If the hypothesis can come true, there will be very potential and profitable investment. Regarding to financial policy, that include debt policy, equity policy, and dividend policy. Each policy shows how it's financed and their acting effects on the next period. First, financial needs of the company is the cash exit. Is equal to the cash flow after operation and investment plus the cash balance at the beginning of the year. and then minus the compulsory repayment of loans. If its value is negative, then we have to come up with a policy to finance it while guaranteeing a minimum amount of the company cash balance at the end of the year. In addition, this policy must follow many other principles, such as the debt capacity model, required debt to equity ratio. In conclusion, the debt policy incurred 46.8 million in debt in the first 3 years. In addition, the company issued 26 million of preferred stock in the first 2 years and then multiplied from 2005 to 2007. We will go to a further detail of each policy in the next part of the presentation. For the debt policy, this one is still long and medium-term debt only. In specific, the maturity of every new loan is 5 years. Our maximum possible debt requirement is that the debt equity ratio is equal or smaller than 1. Interest rate equal to 7.5% because debt equity ratio is not higher than 1. Debt also must follow the global debt capacity with 2 factors. Repayment ratio is always smaller than 4. Debt equity ratio is always smaller than 1. The new debt also followed 20.9 million in 2001 and 20 million in 2002. And the last one for 5.9 million in 2003. So next one with the new debt repayment table. The new debt repayment method is constant repayment. It is the same as previous debt. The consequence of these new loans, including debt repayment and interest expense, have been included in the forecasted cash flow and financial policy table in the previous slides. So next one, I would like to give the floor to Ms. Anh, who will walk us to the next part, equity policy.
About the equity policy, the company issue equity only if the debt equity ratio is less than or equal to 1. For example, there is no more debt capacity. The company issue only preferred share so as not to affect the lot of control of existing shareholder. The company prefers share dividend equal 140% common share dividend. The company issued 260,000 preferred shares in first 2 years and bought them on back in 2007. Dividend policy. Third dividend in 2001 is 38.58 euro per common share with the growth rate of 13% in 2002. This means the CEO requirement for 25 million euro dividend during the first 5 years. The preferred share dividend in 2001 is 20.9 euro per share with a face value of 100 euro. The preferred share dividend growth rate is equal to the common share growth rate. The valuation. Here is the valuation of the company. In our opinion, the simple model and market to book value model are not right model in this case because they are all based on the common value of the market. About simple model, apply general price earning ratio of the sector and is fixed over time. The market to book value model also apply.
Hello? I don't hear you anymore.
The effects methods.
Yeah.
In our opinion, the effect method is future cash flow because it is based on the specific business situation of the enterprise. The free cash flow by method reflect the actual business result of the enterprise. The dividend-based method shows the real amount of money received by the investor. Both methods give roughly the same result. In 2000, the firm value about nearly 130 and 160 million euro. And in 2004, the firm value about 320 and 340. Sensitive analysis show how to the tax rate, interest rate, dividend growth rate affects the value of the firm. Firm value in 2000 is more than 100 million euro. It's more than 200 million in 2001 and more than 300 million in 2004.
So about the IPO for hypothesis 1, an IPO is not required because capital demand under this hypothesis is not high. It is entirely possible to issue preferred shares to meet capital needs without affecting the income and control of existing shareholders. Consider an IPO because it helps increase the value of the shares of existing shareholders. According to valuation models, the market value of this business is always greater than the book value. About the IPO value, in years 2000, the firm value is about 130 to 160 million euros. And in years 2004, the firm value is about 320 to 350 million euros. Future cash flows methods, both free cash flows based and dividend based, show the same firm value result. The sample value models is not effective because the dividend policy selected is the dividend distribution with stable growth, not affected by income even in the negative case.
Okay.
The hypothesis number 2 has the safer assumption. It helps the investor not to set the expectation too optimistic and to prevent against the bad business results. The only difference to the first hypothesis is that the EBITDA to sales ratio, which decreased compared to the first one. The other indicators and policies will be on the same as the first hypothesis. The cost of capital is nearly the same as the first hypothesis, which is 16% in 2000 and 19.6% in 2004. The second hypothesis is the safer one with a lower EBITDA to sales ratio. The first rate, the ratio in the first hypothesis is 30% in 2001, 26% in 2002, and 22% in 2005. However, in this case, it is 21% in 2001 and 2002, and it is 18% in 2005. With all the assumptions stay the same, the business result in this case is lower. The net present value reduced from 215 million euros to 140 million, and the IRR rate decreased from 30% to 20%. Because the business results are lower, the capital needs of the firm increase. Therefore, 46 million of new debt and 44 million euros of new preferred share are issued. All other requirements remain the same as the closing balance must be greater than 0 and the debt to equity ratio must be less than 1. Debt capacity in this hypothesis is always warranted when the debt to cash flow ratio is always smaller than 4 and the debt to equity ratio is always smaller than 1. The company issues 22 million euro of debt in 2001, 70 million in 2002, and 7 million in 2004 and 3. In general, the equity and dividend policy are quite similar to the first hypothesis. Some different points are: first, the preferred share dividend is equal to 120% of the common share dividend instead of 140 in the first hypothesis, and the dividend growth rate is 10%. In this hypothesis, we also have the 5 methods to calculate the value of the business. However, similar to the first one, the 2 methods that we consider effective that are forecast free cash flow based on the free cash flow and based on the dividend. The business was worth at around 250 million in year 2004. Contrary to the previous case, the IPO is necessary in this hypothesis. The demand for the capital is high, and the IPO will help the business to access large amount of capital to serve the needs of the market development. If we IPO in the year 2000, the firm value will be 100 million. And if we IPO in the year 2004, it will be 250 million. These values are based on the future cash flow methods. Both free cash flow and dividend base show the same value. This is also the end of our presentation. Thank you everyone for listening to our analysis.
Okay, thank you very much. I'm a bit surprised by the fact you find same kind of results using the cash flow and the dividend-based models. I have to check anyway with your calculations. A bit surprised. Yes. Generally you have differences. Can you explain that, or you have an explanation or not?
We have an Excel file and we'll send to you later about the free cash flow based on the free cash flow. We use the NPV method. We calculate the net present value in year 2000 and in year 2004. And about the dividend based method, because our please wait me a little bit. Here in our team proposal, we use the same growth rate of dividend every year. So we have to calculate the value of the firms beyond the dividend, and somehow it shows the same return as the net present value, and that's why we think that it is efficient in this case.
Okay, if I understand your hypothesis, there's a kind of arbitrage between equity issues and preferred shares. Is that correct?
Yes, so in our case, we use the preferred share because it won't affect the control of the company because it is the CEO consideration. However, it will however the dividend paid to the preferred share will be higher than the common one.
Okay. What kind of difficulties did you find in the free cash flow calculations?
The first one is that I have to find out which cash flow is from operation, which cash flow is from investment, and which cash flow will be included in the financing activities. Yes. And the second one is that we must control the debt policy and equity policy so that the debt capacity won't be negative in this one. And the last one is that whenever we issue new debt or new share, it will affect the incoming years. Like if we issue new debt, we will have to pay interest and debt repayment in the following years, and it will also affect the forecast cash flow here.
Okay, thank you for this very detailed presentations with many tables and figures and interesting questions. But we have to move to the last presentations. We are already very late, but it's also because we had very good presentations today. So the last group is...
Thank you, sir.
Thank you very much. Kim City number 5. It's number 5 also for Kim City. If you are ready, you can start. Take your time anyway.
Hello,
Don't
Professor.
stress. Yeah, don't stress because we are late. Take your time. Okay.
Yeah, good evening, Professor. Good evening, everyone.
The
We
floor
are
is
the
yours.
last. We are
Okay.
the last group already, and this presentation is made by 4 girls. The former Trần Thị Nguyệt Khánh, Nguyễn Thị Dung, Trần Thị Ngọc Mai, and me, Lê Thị Phương Anh. So I will start now. As you also heard a lot of information about this company from the previous group, but I also need to repeat again, but I go very quickly about this. So biotechnology is the company which is doing business in the biotechnological industry, and this company has a good history, which is established in 1990 by Mr. Vincent, who is the real president of the ownership of this company. So Mr. Vincent, he owns 60% of the company capital. The remaining shares, around 40%, are owned by the venture fund and other directors of the company. So this company is currently focusing on a local market, and they are going to expand to the overseas market soon. So regarding to the growth of the company, there's quite a lot of the strength regarding to this company. The biotech company is the kind of the leading company in this field, so which will create the competitive advantage for them in the local as well as in the international market. Besides that, they also are in the high growth sector with a few competitors in France or at the international level. Moreover, the company's growth rate is quite high. It's around 30% per year. And the last point regarding to the company's strength is the company is successfully controlling its production costs, which were going up rather steeply in the last few years, which supported partially for the R&D development or the acquisition plan in the future. So going together with the strengths, it should be a weakness. Regarding to the company weakness, we can see that the company's cash flow are not sufficient to cover all the funding needs in a high growth situation. Therefore, the company needs to increase its equity by like borrowing a loan or listing on the stock market, which will be discussed later. So how about the opportunities? The opportunity of this company is regarding to the plan. The company is going to invest seriously to the research and development, which will bring a good opportunity for the company to move one step ahead with other competitors, and in order to support them to increase their market size and market share in the future. Besides that, with their existing experience, they seem quite favorable in expanding the market to a new area such as Germany, American, or even the South Asian markets. This company is also in the high growth situation as mentioned, and this situation will continue for the, like, let's say the next 10 years. And what is the threat? The threat this company need to be faced, it will be that maybe more competitors will appear soon in this potential field, and to maintain the market share and the revenues, this company has to invest heavily in R&D or in a new project. And in case if this firm listed on the stock market, the president, Mr. Vincent, maybe not really happy because he's afraid to lose his control of the company in the future. So this is a chart to show the sales and revenue of the company for both positive and negative scenarios. You can see that for the sales and the return on sales, they have the same movement, and it will significantly drop from 2002 to 2003 due to the heavily investment, and after that the sales will surge from 2003 onwards. Regarding to the company cash flow, since the company needs very huge amounts of the money for the project investment, however, they don't have enough equity to implement for this. Therefore, they have to think how to raise new funds in order to complete this investment plan. We also can see that the highest negative accumulated cash needed in 53.9 million euro for the hypothesis 1 and 51.7 million euro for the hypothesis number 2. So how about the funding requirement of the company? As mentioned, the company needs to fund around 55.9 million euro, and the company needs to fund 35.9 million euro and 51.7 million euro for both hypotheses for the business growth, which they intend to start since 2001. Since their cash flow is negative, so they are not able to implement the investment plan by themselves. Therefore, they need to raise a new fund via like listing on the stock market. So we found some reason now to explain why this company should do the raising fund via the option list on the stock market. So the first reason is because this company is they need to raise the capital for to grow their business, and because their available fund is not enough for their plan. So that's why they also need to considering the option to issue the share with the stock market. And the second reason is when this company is listed on the stock market, the investor, they will pay more attention on this company share, as on the company which is listed on the stock market, the information will be more transparent and more standardized. And the third reason is a stock exchange listing may also improve the company credit rating. It means that more and more investors will be willing to invest into this company. And same for other group, we also use 3 methods to do the valuation for this company. The first method is regarding to the PE method. So for the PE method, we calculate based on the data ends of the year 2000. So that's why the value of the firm is same for the hypothesis 1 and for the hypothesis number 2. And for the method market to the book value multiple, we also use the data, the financial data ends of the year 2000. So you also can see that because of that method, so the value of the firm is same for both hypothesis number 1 and number 2, and the value is 1,077 million euro. And you will see the difference of the company valuation in the last way we do the valuation. This is the discount cash flow method. So to do the discount cash flow method, we need to calculate for the cost of the equity, and we also need to calculate for the cost of debt. We base on the financial statement at the end of the year 2000 to calculate the cost of debt. Regarding to the CAPM formula, we calculate the cost of equity based on the variable of expected return of the market and the beta from the year 2000 to 2005. So the WACC is calculated based on the free cash flow for firm back to the year 2000. You can see that for this table, we do the discount for the free cash flow for the firm back to the year 2000 based on the what we already calculated in the previous slide. Regarding to sensitivity, we perform the sensitivity with the change of the WACC from 10.6% to 14.6% in increment of 1%. And the movement of the terminal growth rate from 0% to 4% in increment of 1%. The company valuation changed from 135 million euro to 321 million euro in hypothesis 1, and it changed from 75 million euro to 217 million euro in hypothesis number 2. So conclusion, the sensitivity analysis, so the relationship between WACC and terminal growth rate with the value of the firm. So when the WACC is minimized, it means that the firm value will maximize. Opposite, when the terminal growth with the terminal growth rate, this ratio is maximized, then the value of the firm will be maximized. So for the conclusion, for our team view, we see that using the discount cash flow method in combination with other methods like the trading comparable or the previous transaction analysis, this is such as an effective approach to obtain a realistic range of an approach CH company values. This combination technique is indeed the method that most companies and investment banks use today. So when using the several valuation techniques, the individual subforms are eliminated, and the ultimate goal in the field of the company valuation can be reached, determining a fair and a valid company value. So that's all for our team presentation today. Actually, we prepared a lot of the table, but we didn't show off on the presentation. So if you have any question, please feel free to ask.
Okay, thank you very much. Anyway, you can add these tables to your report as appendix. So yeah, yes, one or two questions. You made a sensitivity analysis. What did you learn through your calculations?
Yeah, so your question is regarding to the sensitivity, right?
Yeah, so you make calculation, you moved with both data, terminal growth rate, discount rate, what did you learn in terms of decision-making process?
Hello, Professor.
Yes.
Sensitivity analysis has shown that the DCF methods is very vulnerable to change in the underlying assumption. Only marginally change in the particular growth rate will lead to huge variance in the terminal value. Since the terminal values account for last portion in the company value, this is the big significance for the validity of DCF method.
Okay. Was it difficult to calculate terminal values?
Sorry.
What about terminal value calculations?
Yes.
Terminal. How about a terminal calculation? I can answer that question. First, I have to calculate the free cash flow for the year in 2005, and then I applied the formula for the terminal value at that year, and then I discount to the present value at the year 2000 with the discount rate is the WACC at that year. Phương Anh ơi, can you show the slides? Yes. No, yes, this slide. So you can see the terminal value 167 here. That means I calculate from the free cash flow for firm after 2005, 32 million, and I discount to present to the year 2000 with the discount rate is 12.6%. And the free cash flow growth rate 2% as assumption.
Okay. I think it was on your last slide, you wrote, it was just at the bottom, weighted average for prudence. Could you explain?
Last slide.
I think it is the last one. Yeah, here. At the bottom, the company can apply all of these methods in the same time by using weighted average for prudence. What do you mean?
Because we applied 3 methods here, and we have 3 values of 3 methods, and they are not similar, they are not the same. Especially in PE multiple, is the company value is higher than the highest in the 3 methods. So maybe when we value the company to IPO the first time, we have to consider which is suitable value to offer to the investor, because they are new investor and we are new in the market. Maybe because PE multiple and market to book value, we just apply the rate of the market, not the real rate from the internal from the company. So I suggest we can choose, we can use the weighted to calculate I mean the average, same, not really average, but I think for the first method, discount cash flow is the similar, is the realistic way, the realistic method to evaluate the company. So we can weight it. For example, we can estimate the PE multiple around 20-25% and market to book value about 25%, and the rest is 50% for discount rate below. So we can use that percentage, the weighted, to calculate the final value of the company, and then we can consider and have the suitable appropriate value, then we can make decision. That's
how do you find the weights?
Because I think in the company side, we want to sell the company with the highest value, but it must be suitable because it's too high. When we offer, we show our value to the market. Maybe some new investor, they think it's an overestimate. So we have to run many scenario to work with them if they have. I mean, sometimes maybe they will consider. If we have prioritized investment, a fund, a big company, they want to buy us, they want to invest more. So we have many scenarios to work with them to negotiate.
Okay.
I think that.
Fine. Okay, thank you very much for these your answers also and for your presentation. You know, I'm sorry because we are late. You know, it's time to go to sleep for you right now. So thank you for these good presentations. You have been working hard, and I liked your presentation very much. So now you get a few days. I sent an email to Lynn and to Tram to finalize your slides and to write your report. You send your final versions to Tram and to Lynn, and we will meet again on the session 5, number 2, on Thursday with the other case, electrical signal, dealing with the question I raised and your the presentations of the other groups, about 50% of the students in Ho Chi Minh City and Hanoi also. But we will meet anyway tomorrow, yeah, for the methodology course, which is pretty different, you know. But I want you to be in line with the process of finding a topic and starting writing introduction, research questions, and methodology. That's the reason why I wanted to have this session right now. So thank you very much, all of you. Good night, sleep well, take care of you, your family, and your colleagues, you know. And I will see you several times this week. We will start tomorrow on Thursday.